Good morning, everyone. Some big news on the real estate front with Sam Zell's REIT, Equity Commonwealth. They have announced this merger right here. They are acquiring Monmouth Real Estate for $3.84 billion. So just wanted to get my initial reaction on this one for this morning, since they're actually going to be going on to a conference call to talk about, I guess, why they're doing this, since it would be great to get some insight there, since this is a big deal for Sam Zell, his REIT, since they've been sitting on a bunch of cash. Get into that in a second. I actually heard about this first from our man, Karan Granani. He saw this within minutes of it actually coming out last night, since I think they announced it at like 10:30 p.m. Central Time. So I was getting ready for bed at that point, and he texted me about it. So thank you to him. Go check out his channel if you haven't already. We've done a number of collaborations before, and we actually have our punch card investing collaboration channel that we're doing with a couple other YouTubers as well. So definitely go check that out. But as for this merger here, like I said, we're going to be listening into their conference call where they are going to be talking about this deal, no doubt. That'll be going live in about 3 minutes. But just for a little bit of background, what Equity Commonwealth is, and then a little bit of what Monmouth is. So Equity Commonwealth here, they are they're a REIT, so real estate investment trust, but they are sitting on a ton of cash right now, about $3 billion or so in cash. And then they have these 4 office buildings. We'll just say they're worth around $500 million. It kind of depends on what sort of cap rates you're using there. But that's what we're working with here with Equity Commonwealth. It's almost like a real estate SPAC of sorts. It's sitting on a ton of cash. Sam Zell is the chairman, and he is very selective, or at least historically has been very selective in how he picks his deals, how he vets his deals. And there was a lot of uncertainty what they were going to actually be going for. And it looks like they ended up going for Monmouth Realty, Monmouth Real Estate, which is an industrial REIT. So that was interesting. Right now, Equity Commonwealth is all office. And there was speculation that it was going to be more office, since Sam Zell has come out as long-term bullish on office. However, he thinks there's a pretty large oversupply in office. So I can't say I'm surprised he went elsewhere. And in previous calls, Equity Commonwealth definitely was talking about how they were being more open in what they were looking for. They weren't just going for office. They weren't just going for retail. They're definitely not going for retail. But they said they were open to different opportunities. And clearly industrial was on the radar as well. Industrial has definitely been a hot commodity, or a hot real estate sector over the last really few years, especially these last couple of years. As retail has fallen, it seems like that as retail has fallen, industrial's kind of picked up the slack, since people still buy stuff in industrial. Think Amazon warehouses, light manufacturing. That it's a very broad category, since it's generally pretty low overhead from a management perspective. And Monmouth, as I'll get into, does have that sort of approach, that net lease approach. Let the tenant take care of a lot of the expenses and then go from there. So it's pretty easy to manage, relatively speaking, but you're going to lose some rents there too. So it's all works out in the price. It is a slightly different game though, but probably more similar to office than most other sectors. In that you got the building space, you rent out the space. The tenant typically takes care of a lot of the expenses. You might provide some amenities, and that's kind of it. But anyways, it's 9 a.m. Central Time, so let me get on to the actual earnings call. Or I believe this is going to be it's an earnings call, and they're going to talk about the actual merger. So let me see if they're live yet. They are still just playing elevator music. So we'll wait a second for that to go live. But as you can see, let's take a look at stock charts, because we love stock charts in the stock world. But interestingly, the market hasn't seemed to really enjoy, from Equity Commonwealth's perspective, this merger. They had about a 7% drop since yesterday, after this merger was announced, which is, I think, slightly surprising, since it's just been sitting on cash. So people might think that Equity Commonwealth is overpaying for the amount of Monmouth Realty, which has gone up. So, which would make sense that one side would go up, the other would go down, because this is a share for share swap, Equity Commonwealth is surrendering 35% of their shares in exchange for 65% of Monmouth shares, which, if you actually just do the math on a market cap basis, it's pretty close to equal. Oh, and here's the earnings call.
At this time, all participants are on a listen-only mode. A question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press *0 on your telephone keypad. As a reminder, this conference is being recorded. I would now like to turn the conference over to your host, Sarah Burns, Senior Vice President, Investor Relations and Capital Markets. Thank you. You may begin.
Thanks, Rob. Good morning, and thank you for joining us today. We will be discussing the recently announced merger between Equity Commonwealth and Monmouth Real Estate Investment Corporation. On the call today from Equity Commonwealth are Sam Zell, our Chairman, David Helfand, President and CEO, David Weinberg, COO, and Bill Griffith, CFO. Please be advised that certain matters discussed during this conference call, including relating to the pending merger, may constitute forward-looking statements within the meaning of federal securities laws.
Nothing set in stone, guys.
We refer you to the section titled Forward-Looking Statements in the press releases issued yesterday, as well as the section titled Risk Factors in our annual report on Form 10-K and quarterly reports on Form 10-Q for subsequent quarters for a discussion of factors that could cause actual results to materially differ from any forward-looking statement, including any statements regarding the overall impact of COVID-19. The company assumes no obligation to update or supplement any forward-looking statements made today. We will make important filings with the SEC in connection with the pending merger. Today's call is not intended to be and is not a substitute for those filings. We urge you to read those materials carefully when they become available before making any voting or investment decisions. We also post important information on our website, including information that may be material. The portion of today's remarks on our quarterly earnings also includes certain non-GAAP financial measures. Please refer to yesterday's press release and supplemental containing our results for a reconciliation of these non-GAAP measures. With that, I will turn the call over to Sam Zell.
Good morning, everybody. Thank you for joining us. We are thrilled to announce the signing of a definitive merger agreement to acquire Monmouth Real Estate Investment Corporation in an all-stock, tax-free transaction. Those of you who have followed EQC for the past 7 years know that we have evaluated a broad range of sectors and businesses. We have pursued contrarian opportunities as well as searched for differentiated ways to enter more favored sectors. Our perspective after reviewing a significant number of potential deals is that the current environment is mispricing risk, and therefore what would otherwise be opportunistic scenarios are priced as though the opportunity was understood in advance. In response, we have focused on sectors with strong fundamental tailwinds and businesses with high quality cash flow from creditworthy customers. Obviously, the industrial sector meets that test, and the Monmouth portfolio in particular reflects that opportunity. Moreover, using EQC stock was a very important part of this transaction, because it meant that subsequent to the merger, we would have a very powerful company with an enormous amount of dry powder, able to take advantage of what is, we believe, for the next 4 or 5 years, maybe the #1 growth area in real estate. So we're very excited about the process, and we believe that we can convert Equity Commonwealth into the kind of successful public companies that we previously sponsored in terms of EQR and ELS. Our culture has historically reflected open communication, rigorous risk management, and shared commitment to superior performance. Before I turn it over to David Helfand, I also want to acknowledge Gene Landy and his team for their efforts the past 53 years. Guys, we'll take it from here.
Thanks, Sam. For EQC, the industrial business.
So interesting that they're deciding to keep that cash pile. That explains sort of the stock swap, in that they're still going to have a bunch of cash to go. But let's listen to David Helfand, now the CEO.
Of the pandemic. Demand for quality, last mile distribution facilities is robust. Monmouth's modern, single tenant, net lease portfolio offers outstanding credit quality and long dated leases that provide stable cash flow. Going forward, we expect EQC's earnings to be driven by the strong fundamentals of the industrial sector and the growth of e-commerce. With respect to the deal, we're acquiring Monmouth in an all-stock transaction valued at $3.4 billion, including the assumption of debt. We expect to repay Monmouth's $550 million of Series C preferred stock at closing. The combined company is expected to have a pro forma equity market capitalization of $5.5 billion. Monmouth shareholders will receive 0.67 shares of equity Commonwealth for each share of common stock in Monmouth. Based on our closing price yesterday of $28.95, this represents $19.40 per Monmouth share. In addition, Monmouth's next quarterly dividend of 18 cents will be declared in July and paid in September. Taking the dividend into account, the total consideration to be received by Monmouth shareholders is $19.58 per share based on yesterday's closing price. With our demonstrated ability to execute, significant cash, and balance sheet capacity, EQC is uniquely positioned to grow from this strong foundation. With that, I'll turn the call over to David Weinberg.
Thank you, David, and good morning, everyone. Monmouth owns a 99.7% leased, 120 property portfolio of single-tenant net leased industrial buildings that totals 24.5 million square feet. It is located across 31 states with a focus on the eastern United States. The average remaining lease term is 7.4 years, and 83% of the rent is from investment-grade tenants. Most of the properties were recently built with an average age of 10 years. Over 80% of the properties have clear heights of 24 feet or higher. The average coverage ratio is 21%, with many properties having extensive parking areas for both trucks and employees and providing future expansion opportunities. We believe these types of buildings best serve today's distribution tenants and are well positioned to capture future demand from the growth in e-commerce. Monmouth has strong relationships with numerous investment-grade tenants, in particular FedEx, who leases 63 properties, representing 55% of Monmouth's rent. Many of these leases have flat rents, which limits growth. We took this into account in pricing the deal. The NOI yield on the real estate is 4.7%, or 4.6% including transaction costs. As I described, this is a newer portfolio with long-dated leases. Accordingly, these properties should have below-average capital requirements, and there will be a smaller spread between the NOI and cash yields. To say it differently, compared to other portfolios of like quality and credit, when accounting for the difference in lease roll and capital, we believe this deal's average 8 to 10 year cash yield is similar to higher growth deals priced in the low to mid 4 cap rates. Finally, I would like to reiterate Sam's comment that this deal is the foundation from which we intend to build a first-class industrial business. This portfolio of high-quality real estate properties with long-term leases to investment-grade tenants will generate stable cash flows. Combined with our balance sheet, we look forward to growing the platform and creating long-term value for shareholders. With that, we will now open it up to questions.
At this time, we'll be conducting a question and
So
answer session.
a big focus on that sort of liquidity aspect, and that they're keeping their cash balance intact. Of course, they're surrendering shares for it. Equity Commonwealth surrendering a large number of shares, but they still are very liquid. And rather than having to issue new shares, for example, they could just use the cash, the dry powder, as Sam Zell called it, to go and make more acquisitions. And let's see what they're asking about.
Our first question comes from Manny Korchman with Citi. Please proceed with your question.
Hey, it's Michael Billerman here with Manny. Sam and David, thank you for the opening comments. I want to know, sort of, when you step back, sounds like you have, and as we've talked about for years, evaluated a lot of different opportunities. I guess coming out and seeing a company buy, using their currency to buy another REIT that shareholders could have had access to in a sector where everybody and their mother is tripping over each other to deploy capital, not necessarily the type of transaction I think the market was anticipating, given how much time had been spent talking about trying to find something opportunistic, value creating, maybe somewhere that someone could leverage the cash on your balance sheet, the management that you have involved in the different property sectors. And so how does this sort of line up with the ability to maybe just do nothing and return capital to shareholders? I guess why do this versus the third alternative, which is do nothing and call it a success on taking out Commonwealth and deriving a lot of value.
Sounds like Citi doesn't like this deal and would rather just have the cash in their pocket.
Sam, I'll try and give you my perspective on that. I think we obviously took into consideration all of the factors that you laid out. We felt that the opportunity to acquire this portfolio and match it up with the cash that we have available to us, and frankly, a pretty superior real estate related management team, we really felt that with the base that this portfolio provided, we would have the flexibility on a transaction by transaction basis to add significant value going forward. I assure you, we've looked at all kinds of different opportunities, including the disposition of the cash balance and calling it a day on EQC. And as a significant shareholder, and I looked at those two alternatives and I said, I'd much rather have a stable base and an opportunity to take advantage of the skill set that's evolved than to find myself, a distributor of or a recipient of cash and then attempting to find another area for investment. I believe that, yes, the industrial space is very crowded at the moment, but I don't think it's crowded with too many people with $5 billion of buying capability and cash on the balance sheet. And it's going to be up to us to find ways to take advantage of that set of circumstances.
And then when you talk about some of the sectors that were contrarian plays, and I would suspect lodging, retail, office, maybe even senior housing, everything that's been reopening, you talked, Sam, about people mispricing risk. I think in many ways, given what you know about those sectors, the fact that you're not doubling down in those potentially or re-entering those sectors, can you talk a little bit about the framework of not buying in those? Because one would argue if Sam Zell came around and put a stake in the ground on retail or returning into office, that may have more meaningful than being, arguably a little bit late to the industrial party, at least in the U.S. from a platform perspective.
The city is very skeptical of this deal.
I don't think we're too late. I think that the industrial sector has a very significant amount of room yet to grow. As to the other areas of involvement, I've made reference both publicly and privately to the effect that I thought that real estate was a falling knife. Last I checked,
that's for retail.
The knife was still falling. I may think I'm smart and I may think I'm surrounded by a very talented team, but I don't know that they're very good at catching knives, nor do I know anybody who is.
Is that retail that you're referring to?
Yeah, I'm referring to retail. So as far as I was concerned, there obviously is going to be an opportunity in retail. I just don't think it's there yet. As far as the hotel space is concerned, Again, I don't think the hotel business is going out of business, but I think if I look at the pricing of hotels and the pricing of hotel REITs, and I can't relate that pricing to the way I see the opportunity. So that kind of eliminated that area. As far as office space is concerned, I've also said frequently that this is a very interesting or unique scenario because the office space market was oversupplied before the pandemic. The pandemic has certainly not generated any belief on my part that demand is increasing, and yet I think the oversupply is going to impact that area very significantly over the next few years. Plus, I think that the CapEx requirements in the office market are just another way of reducing price, and we felt that at this particular point and at this cost of entry, that area didn't make sense. I assure you that we've considered all
CapEx
of
is capital expenditures, so the money you have to spend to keep up the property.
Capital, and we believe this is the most opportune result we could come up with.
Okay, thanks for the color. We'll requeue.
So interesting there, Sam Zell kind of rattled off why he didn't do every other sector per the question. Retail, he says, is a falling knife. He said that a bunch of times already. Office, he doesn't like the oversupply compared with the expenses that you would have that would hurt the price even more. So it seemed like industrial might have been one of those few sectors that was, I guess, not in this weird sort of suspension where fundamental values seem to still make sense. However, it still is kind of strange given that, as City kind of points out, maybe they are late to the party in industrial. It already has had a huge run up, but Sam Zell seems to think that that runway is a lot longer. But let's see what the next question is.
Our next question comes from the line of John Kim with BMO Capital Markets. Please proceed with your question.
Thanks. Good morning. I just wanted to follow up on the commentary that you're seeing cap rates in the mid to low 4 cap rate range for competing product. Was that for single tenant net lease industrial assets? And also, are you seeing portfolio premiums in the market today for industrial?
I'd say yes and yes. So we've been tracking and looking at industrial now for a couple of years, and there are many comps around the country where you're seeing single tenant net leased assets trade in the low to mid 4 caps. Obviously, it varies by credit and market. And given the amount of capital chasing industrial, there is a sweet spot where, depending on the portfolio size, it's no secret that that is trading at a premium. In fact, there are quote unquote aggregators out there who are trying to consolidate portfolios so that they can take advantage of the ARB and sell it as such.
I'm not sure if Mike Landy's on the phone or available for questions, but why was this offer done in all stock? And, why was Monmouth willing to accept an all stock offer rather than some cash component, given there has been a competing bid that is all cash?
Yeah, Mike is not on the call, and you'll have to direct that to Mike.
Okay, maybe you can comment that from the EQC point of view then? Like, why not offer Monmouth shareholders some kind of cash component?
I think, to repeat what I said before,
Dry powder.
a very important part of this transaction was the creation of a significant and powerful industrial company. There are lots of industrial companies. There's a couple that are very large and very powerful, and then the size drops off significantly. We felt that the opportunity to create that kind of an entity was going to translate into better results going forward and provide our investors with a much better option than just an all-cash deal.
Yeah, Sam Zell really values that liquidity. He wants to keep that cash ready to go, so that even if it means surrendering some shares, you've got this huge base of properties. You have the foundation, as he called it. So you have this foundation of cash flowing industrial properties, but you still have all this cash that you can use to invest in a bunch of other deals.
In terms of new acquisitions, geographic concentration, development opportunities, et cetera?
Yeah, thanks, Dan. I think looking forward, we love the space broadly. It'll depend on pricing, in terms of what markets we're going to grow in initially. But as Sam said, the long-term play here is to build a fully integrated value-add industrial business capabilities across the board. And where exactly we focus will be a function of where the opportunity is. There is lots of industrial and lots of places that will complement the existing Monmouth portfolio, and our capacity on the balance sheet will allow us to access those opportunities.
I would add that the existence of our balance sheet, the existence of a very conservative base, gives us the ability going forward to take more risk and to take on perhaps some more unique situations that we otherwise wouldn't do because they would be too impactful to a company. So from our perspective, what we've done is we've created a vehicle that allows us to cover all the different possibilities, knowing that our underlying base was well protected, and therefore we could do things that on a one-off basis might be too risky or not benefit enough for us.
So to follow up on that, I guess with the large concentration to FedEx and this balance sheet, I guess it would be fair to say that potentially this new vehicle would have more value add or development exposure than it would have without this the financial backing of EQC.
I think there's very little doubt that we're highly sensitive to the FedEx exposure. When you look at what we're paying for this company against what FedEx debt trades for, we're getting a significant premium for owning the buildings rather than owning the debt. But clearly, our goal going forward would be to diversify away from that kind of concentration and also do things that are the opposite of purely net lease scenarios to a highly credited tenant.
So adding in, I guess, lower quality tenants perhaps, or higher rents for that, since it's so concentrated into FedEx right now. Half the portfolio, the Monmouth portfolio, is FedEx as a tenant. That's a lot of risk in just one tenant.
Potential deal.
No, that's not publicly disclosed.
Not sure what that question was, but it looks like they didn't answer it.
Our next question comes from Rob Stevenson with Janney Montgomery Scott. Please proceed with your question.
Good morning, guys. EQC hasn't paid a regular dividend quite a while. For Monmouth shareholders, how are you thinking about reoccurring quarterly dividend and any potential timing for that?
I think they're planning on doing that per the announcement.
Obviously, the dividend question is one that the board will have to answer. But given the cash flow dynamics of this portfolio, we do expect to be commencing a dividend,
right.
Shortly after closing, the amount to be determined.
Okay. And is there a floor on the deal price depending on where EQC trades? In other words, if EQC trades down to 25, then the deal price is $16.75. Is there a repricing mechanism?
There is not.
Okay. And then last one for me. Sorry?
I was just saying fixed exchange ratio.
Okay. And then when you're thinking about it, how scalable do you think Monmouth's build-to-suit business is? Or are you basically going to be out there in the market? Are you guys thinking about development as well?
Yeah, I think as Sam said, we're looking at all different ways to add value using Monmouth as the foundation.
Okay.
And
thanks,
I also think that apropos of some of the questions that were previously asked, I think there are elements of the real estate industry today where you might match up a couple of different things. So, just like Google took over a major shopping center in California and turned it into an office park, I think there may be other retail in other parts of the country that very much lend itself toward industrial redevelopment. So we wouldn't be sensitive to or averse to taking on those kinds of responsibilities, particularly with the kind of economic base we have as a point of starting.
Okay. Thanks, guys. Appreciate the time.
Sam Zell is very pumped up about having a foundation. He
As a
seems to keep
reminder, if you'd like to
reiterating
ask a
this theme of
question,
having
please
Monmouth's
star one.
existing portfolio as the foundation
One
and a
moment.
springboard to do other things.
Our next question comes from Manny Korchman with Citi. Please proceed with your question.
Another city
Good
person.
morning, everyone. No, it's Manny. You guys, I think a few times on the call have talked about buying this foundation within Monmouth and talking about things like retail conversions, talking about ground-up development, built-to-suits, running an integrated industrial platform, and that's all stuff that Monmouth didn't really do. It was more buying, merchant-built, net lease standing industrial assets, newer ones from others. They didn't develop in-house, and now you're talking about building all that out. So kind of what does the platform provide from that perspective, and then how many people from both organizations are going to stick around as you embark on this journey?
Yeah, thanks, Manny. That's accurate. Monmouth hasn't in the past done that. They've had a specific strategy they've executed on. We're going to have a broader strategy. To your question of the team, what we've disclosed is that there's a year transition so that we can smoothly hand off. As we grow, we expect to get to know the Monmouth team and determine whether they'll be part of our team going forward. We're hopeful that we can build off that talent, but we have industrial expertise in our shop, experience across our team, and we own 6.5 million feet in Commonwealth. We've owned industrial in the past, so we feel confident in our capability, and we'll sort of take the best of both teams and put them together.
I do wonder what kind of instability they're going to see there.
Be asked, but I'll ask it anyway. But is sort of the search for other opportunities over, or is there the chance that, given the acquisition team still being in place at EQC, that you guys are actually looking beyond this to put the capital to work?
I'm going to guess they'll say no.
Single asset or portfolio deals in industrial.
I think the bottom line is never say never.
Right.
I don't think that we currently have any specific plans to do anything other than to build out off of the portfolio that Monmouth represents. But I certainly would not preclude any other diversions depending on circumstances.
And the last one for maybe David Weinberg. Given the FedEx exposure and sort of that single tenant, whether it be risk or opportunity, is that a funding source near term or longer term, or some other structure where you unlock some of that FedEx exposure and credit and eliminate that not just through growth but through sales or dilution?
So selling the FedEx buildings?
The punchline, not through growth, but through what?
Well, through sales or through so just
I think when
selling it off rather than growing out of it.
Yeah. So look, in the short term, we're going to wrap our arms around this portfolio, figure out where there are opportunities to create value. We're not walking into this deal looking to flip a bunch of assets. Medium term, long term, perhaps, but it's not a question we're trying to ask or answer today.
What about securitization of those leases?
I don't think we plan to do that either. That it's another form of exit.
So they're not going to say what they're really planning yet. If they're going to sell a portion of the portfolio, for example, maybe rather than try to grow out of that super concentrated FedEx portfolio, they actually sell out of part of it. That could be something they do. They did that with Equity Commonwealth in the first place, and they sold out a bunch of office buildings. Could be a repeat.
Securities book and the development assets.
Yeah, so that is a real estate cap rate, and I'll take a moment and just kind of walk through the map so there's no misunderstanding. If you look at their Monmouth's earnings release, March 2021, they reported a GAAP NOI of $38.7 million. If you walk that to a cash NOI and you look at historicals, that will be around $38 million. Annualized, that's $152 million. And then they've got those 8 FedEx ground parking expansions in progress, which will be costing them about $31.4 million. Historically, they've earned about a 10% yield on those types of investments. So $3 million plus $152 million is $155 million. That's our numerator. And our denominator is a walk, starting with the stock price and making balance sheet adjustments to get to the real estate value.
Okay. That's a lot of accounting magic to get to a cap rate.
The non-answer on the breakup fee, will that be disclosed at some point?
That will be disclosed later today in an 8K filing.
Okay, great. Thank you.
Our next question comes from Daniel Ismail with Green Street Advisors. Please proceed with your question.
Great. On the residual office exposure, are those assets already being marketed? And I'm curious the type of reception those assets are being received.
That's the 4 original office buildings.
Our office properties are not currently being marketed. We continue to work them, and we'll look for opportunities when it may make sense.
If they're pivoting to industrial, it would probably make sense to ditch those office buildings at some point.
Our next question comes from Rick Smith with Smith Capital. Please proceed with your question.
Hey, good morning. Before I start, I'm going to butter you up, Sam. You're a legend. I've followed you my entire career. Look, Blackwell's put a statement out, and the statement says, the industrial REIT space is materially re-rated since our 18 bid. Had the company engaged with Blackwell's and not excluded it from the process, they would have been prepared to potentially increase their all-cash offer. So were they part of the process? And if not, why not?
We can't comment on that. Appreciate the question, but we can't comment on that matter.
We have reached the end of the question and answer session. At this time, I'd like to turn the call back over to David Helfand for closing comments.
Closing.
Thank you for your time today and your interest. We look forward to working with you in the future. Thank you.
Short and sweet.
Today's conference. You may disconnect your lines at this time, and we thank you for your.
All right. So there you go. That's the Equity Commonwealth announcement. They are acquiring a large portion of Monmouth Real Estate, an industrial REIT. Just want to reiterate some of the things that mainly Sam Zell was highlighting. Sam Zell being the chairman, the famous real estate investor. Got plenty of content about him on my channel. And I should have disclosed earlier, I am a shareholder of Equity Commonwealth. It's actually one of my largest holdings. Hence my clear interest in this. Plus, it's interesting to see what a great investor would be doing during this strange time in real estate. But the overarching kind of theme you heard with this deal, that Monmouth was their industrial portfolio as it is serving as a foundation, a springboard into other opportunities. And they can say that because they're not surrendering all their cash. Equity Commonwealth's big thing was the fact that they have a ton of cash. They have $3 billion or so in cash. And rather than using the cash to buy the deal, they are instead swapping shares with Monmouth, and they're getting a majority stake in Monmouth so that they have that portfolio as a springboard. And then they can then use the cash to go buy other opportunities, maybe within the same, probably not within the same class of industrial. They were saying they wanted to go for maybe more creative opportunities. So maybe this isn't really the big deal that Sam Zell has been alluding to. He's been alluding to wanting to find a big creative deal. His track record suggests that he always goes for things in distress, tries to get them below replacement cost. That doesn't really seem to be the case here. This seems to be almost more of a lateral move as opposed to a sort of upward value creation move. Just wants to have something there, bring in cash flow, perhaps get some new excitement, build some more expertise in industrial. Since you heard a lot of skepticism from the shareholders there that Sam Zell was late to the game on industrial and that shouldn't have been doing that, or should have focused on office or something else that wasn't retail. So, or that wasn't industrial. But he was like, pay no, there's still plenty of runway here for industrial. We are not regretting this decision. This is a big move, and we still have a lot of dry powder, as he calls it, to go. So that's kind of this overarching theme. It's interesting to hear their perspective on why they're doing this as opposed to something else. But granted, there's just not a lot out there right now in any sector of real estate. The market's kind of in a suspension. Even if the fundamentals might not be as great as they were last year, the prices have remained the same, if not much higher, because you got a lot of government backstopping and a lot of uncertainty, just not many transactions. So it's hard to find those sort of big value plays at the moment in real estate and really in most of the securities market as well. So that could explain why they went this route instead. Then you also heard about the tax consideration. It's a tax-free exchange of stock, which is nice. It keeps some of that cash and liquidity ready to go rather than having a big taxable event. So that's kind of it. I'm going to check my notes here, make sure everything. Yeah, strong fundamental tailwinds was the exact word that Sam Zell used. He suggested mispricing compared to the opportunity. So it's probably not below replacement costs right now, but the mispricing is in the fact that there's a lot of future growth ahead for industrial. So you could call it pretty speculative. He seems to think he's getting it into an undervalued opportunity, obviously, otherwise he wouldn't do it, but perhaps not as much of a smoking deal as he might get elsewhere. And clearly the importance of keeping that cash and liquidity was top of mind for Zell and the team at Equity Commonwealth for doing this deal. They still have that cash ready to go, and that keeps them nimble for the near future. Ron here is saying that industrial is the only sector of real estate that has less exposure to interest rate than others. True. It all depends on debt, of course, and how much debt's there. But the fact of the matter is that industrial is a very low kind of overhead business compared to most other types of real estate. It's perhaps the lowest when we're talking about actual buildings, not just land or something like that. You can get more and more passive with things. But generally with an industrial tenant, the manager are not really doing anything to the property. You give them the space, maybe you give them a build out allowance, and then the industrial tenant will actually build out their space. They maintain it, they pay the taxes. That's typically what you mean by a net lease, which all of Monmouth's portfolio is, which I also want to get into, by the way. Here is Monmouth's portfolio. If this will load, my internet's been getting slightly slow in the last half hour. Here you go. And there it is. Oh, I didn't even know there was animations on here. This is Monmouth's portfolio blueprint. So it's something like 120 properties, if I'm not mistaken. And this is the sort of property you're dealing with. These kind of warehousey industrial. FedEx is their largest tenant. This is what the portfolio looks like. It's buildings like this that aren't going to have a ton of amenities, if any at all. It's just give them the space, and almost like if you build it, they will come sort of deal. And that's the value you're providing in industrial, providing space, ideally in a decent location next to transit hubs, airports, rail, that sort of stuff, highways, of course. And that's what the portfolio is. So this is what Equity Commonwealth, the formerly office REIT, sells off all their big buildings and then moves, it keeps 4 office buildings and now is moving into industrial as a new focus, which obviously raised some eyebrows for shareholders. It's raised some eyebrows in the market. As I mentioned earlier, the stock is down today a fair chunk, given that this is mostly a cash entity. It was down 7% earlier. So a slight recovery from the down 7% earlier. No, it is down 7%. So not a great morning for Equity Commonwealth shareholders, but at least in the short term, this certainly is an interesting opportunity. I'm not sure if I'm going to be buying more yet. I need to do some more research on what they're actually getting into with Monmouth. This is just kind of my initial reaction, hearing what the board had to say about it, why they're doing this decision, because it's important to understand that first. What's the goal with this transaction? This is a short-term flip. Are they planning on selling out a bunch of things? They were kind of unclear about that. I certainly wouldn't put it past them, but they're clearly still shopping for other deals too. It just seems like their focus might be on industrial now as opposed to other sectors, which probably is one of the few sectors in real estate that has large, at least in my view, not financial advice, of course, has a large runway ahead of it compared to, say, office, which is very uncertain right now. Zell's talked about oversupply. it makes office less attractive than something like industrial, where it seems like you can't get enough of it right now. Amazon's buying stuff left and right, or renting stuff left and right. FedEx is a big one. Anything in distribution is going to need that space. Sam Zell SPAC, after all, I think it's EQD or equity something distribution. His SPAC is looking for a distribution tech company. So he's obviously been looking at the industrial space, and perhaps that's been sort of a driver towards this decision. And exactly what Karan's saying, trends in e-commerce affect industrial more than anything. I would 100% agree there. The way I always look at it is where retail falls, typically industrial will rise. Since people are still buying the same amount of stuff, I mean, compared to last year, Americans at least are buying more stuff than ever. And someone needs to provide that stuff. And typically it's industrial right now with the e-commerce revolution. Got to put that stuff somewhere. It's just not, now it's not in storefronts. It's in the modern storefront, which is a warehouse that's then shipped to someone. That's the way I view it. Of course, there's other things in industrial manufacturing. You could, it's a very flexible space, obviously, since the tenants are the ones that are actually doing the maintenance and any retrofitting that the property might need, generally speaking, if it's a net lease, which it is in this case. Before we wrap up, just we can go a little bit more about what Monmouth is. High quality net leased industrial properties on long-term leases to investment grade tenants, or more like an investment grade tenant in FedEx being half the portfolio. It's enabled them to deliver reliable and predictable returns. I think that's that foundation that Zell was talking about. Now they got this steady cash flow stream. They've been sitting on all this cash right now. Maybe have a little inflation protection. They are taking on Monmouth's debt as well, which adds a little bit of risk, but they still have all that cash ready to go, so they could probably weather a storm for quite some time. What we do, trying to see anything. So I do wonder what's going to happen to this team here, since Equity Commonwealth's becoming a majority shareholder of Monmouth, and I'm sure many of these people will be out. I'd imagine. Sam Zell's got his people, and he's going to probably keep them. So we'll see what happens there with the team, and I'll certainly keep you updated either way. And I plan on doing a more in-depth breakdown on the Monmouth portfolio, the value, the actual balance sheet of Monmouth, and that sort of stuff. Just doing some real high-level things right now, getting an initial reaction on the deal. So if you're interested in that, definitely subscribe, and thank you all for stopping by as well. Just one more look at, and here's that internet I was talking about. I want to take a look at their balance sheet real quick to see what Monmouth's got going on, if it ever loads on Ticker Terminal. There we go. So if we go down to financials, revenues have been on the up and up, which is good. Rents going up through time as they've built up the portfolio. I don't know their recent history, how many acquisitions they've made. They made it sound like a lot of these deals were newer, which would mean that they'd have less maintenance obligations, as in big capital expenditure obligations, not tenant maintenance, but roofs, any landscaping or whatever the property happens to need, pavement, that sort of stuff that wouldn't be covered perhaps in a net lease. But a lot of the ongoing operating expenses would be covered within the net lease. You can see, let's see, where's that debt balance sheet? Long-term debt, so about $874 million. Right, this in in millions. $874 million in long-term debt, and that's about it. Compared to how much property? Well, total real estate assets of $1.74 billion, which it ends up being about their market cap. You subtract debt from that to about $1.1 billion. This is obviously assuming that's what these are actually worth. This is taking depreciation into account, which isn't really accurate. Depreciation is more of a tax write-off in real estate. So really, it's more like a $2 billion portfolio, I'd imagine. Whoopsie, what happened there? But again, this is what I'll be doing more of a breakdown on later. And I know Karan Gurnani and I have been talking about doing a collaboration in the near future as well, so watch out for that. But we'll definitely be taking a look at what the actual value of this portfolio is, or an approximate value, see what kind of deal Equity Commonwealth's getting here. But Equity Commonwealth is assuming the debt from the press release, if I'm not mistaken. So adding some debt to the currently clear balance sheet of Equity Commonwealth, which is practically all cash right now. But they still are keeping that cash again, taking on the debt, taking on some risk here with the portfolio, but frankly, not a lot compared to their cash pile. And they're not even surrendering that cash pile. So if they wanted to pay off this debt, they could. I don't know what rates this long-term debt is at, probably pretty good. But with commercial, a lot of it is adjustable after a few years. So you're always going to have some interest rate risk, generally speaking. Not like a 30-year fixed rate mortgage on a single family home for a lot of US homeowners. It's different in the commercial space. So yeah, that's about it. If you guys have any last minute questions I could take a look at real quick, just definitely let me know. But that's kind of what we're working with here. We got Equity Commonwealth merging with Monmouth Realty. 35% of Monmouth shares are going, or 35% of Equity Commonwealth shares are going to Monmouth, and 65% of Monmouth shares are going to Equity Commonwealth. So Equity becomes a majority shareholder in Monmouth, and then Monmouth gets a large minority stake in Equity. So that's the general deal structure, and we'll see how much of a springboard this really is for Equity Commonwealth in the future. Is this going to be what creates the sort of titan of industrial that they seem to be trying to create, this high quality industrial force, in a similar way perhaps to how Sam Zell built a high powered office empire? And the equity office was a huge equity office was a huge office REIT, and he built his name, or a large part of his name, in shaping the office industry. Could he do the same thing with industrial, even if he is a little quote unquote late to the game? We'll see what happens. I'm certainly excited for it. I don't plan on selling, that's for sure, unless I find something really bad in here. But on the surface, I like the deal. They still have their dry powder. Sure, you're getting some dilution there. You're losing shares. So it's kind of cash in another name, but they're still very liquid is the point. Everything has a cost, and nothing is free. And that includes mergers. Nothing is free. So that's what we're working with there. Thank you, everyone, for dropping by this morning here in Chicago. If you're elsewhere in the world, it might not be morning. Good afternoon to you. And definitely stay tuned for more updates on Equity Commonwealth. Definitely coming out with some more content on it in the near future, very near future, if not tomorrow probably is what I'm going for. Do a more detailed portfolio review of Monmouth and see if there's any more information we can get on this direction that Equity Commonwealth is taking. Until next time, take care.